Right. So thanks for that. Last time I looked at what exactly a stock market bubble was, what caused it, what sort of things happen in the market that lead to one. And we ended by looking at the dot-com bubble, which was the latest bubble realistically during the 2000s. We looked at how the NASDAQ, which is a tech-heavy stock index, went from about 500 points, to over 5,000 in just 5 years. And then within 2 years, lost 80% of that value. Today, we're going to look at some potential indicators that we might be in a bubble in the present day. So if you look at the internet, if you go and Google, are we in a stock market bubble? You will get a selection of headlines like this. Some of them are more interesting than others. I quite like this top one here. If it looks like a bubble and swims like a bubble, for some reason that just really tickled me somewhat. But there seems to be more and more evidence of veteran investors and institutional investors talking about overvaluation, about a disconnect between the stock market and how the companies are actually doing. So we're going to look at a few reasons why that might be the case and some indicators that it might be happening. First of all, what's causing a potential, what might be causing a bubble? Well, it comes down to hype, speculation, and complacency, and that comes down to boredom. So I don't know about you guys, but I've spent the majority of this past year sitting in a small enclosed space. None of you guys know, well, only a few of you guys know my flat, but I have a bedroom that's 2.5 meters by 3 meters long, and I am just over 2 meters, so I barely fit in it, and it's like a prison cell, honestly. I've gone a little bit mad this year. Chris started out mad, but we will pass over that. And that is not an experience unique to me. That is an experience that the whole world is dealing with. And what we're getting is a lot of people who don't know what they're doing, new retail investors, new retail traders, jumping into the markets. They've gotten stimulus money from their government, they're working from home, and they're bored. And when I talked about what drives prices, what drives the price of stocks, I talked about there being more buyers, more money in the market, that drives prices up. And that's exactly what has been happening this year. We've got lots of people who don't know exactly what they're doing. They might not know how the stock market works. They might not know what drives the price of stocks. And they're just buying and they're buying and they're buying because so far it's working for them. Stocks are only going up. I'd like to point out, this is satire. Please don't actually believe that stocks only go up. They definitely don't. But so far, they've been proved right. This is the euphoria stage of what we talked about last week. People have completely disconnected from the thought of buying profit from a company, which is what investing should be, and are just now buying stocks to sell later for a higher price because they think they're going to go up. So let's look, but that's not just retail investors, that's institutional investors. Now, they're less about not knowing what to do, and they've just become a bit complacent, right? So every time we start to get to a lead up to a bubble, it incentivizes people to believe it's not a bubble, right? They want to believe that what they're doing, the reason they're making money is smart decisions. It's not just because the entire market's going up. So they've always got reasons about why it's different, why it's changed from the last time, why this isn't like the dot-com bubble. But the truth of the matter is, it's a lot more likely that just the market is swelling on an influx of money than a whole bunch of hedge fund managers have suddenly gotten better at their jobs. So let's look at a few things that might indicate that the market is overvalued and due for a massive correction. So when you've been looking at your stocks, when you've been analyzing your companies, you've seen on the calculation sheet something we call the PE ratio. Now, the PE ratio is an indication of a company's value to how much profit it produces, right? The PE stands for price to earnings, the price of the company, the price of the share, to the earnings per share that it produces, okay? Now, for us as investors, we want to see low PE ratios when we buy, because that means we can get more earnings per share, more profit for a lower price, okay? Now, this graph shows the price to earnings of the US market over time. The whole stock market, actually, it shows it from 1870 till the present day. Now, I've put a big green line at the average price to earnings ratio, and you can see that for most of the time, it just oscillates around it, vibrates up and down. But there's been a few times where it's really shot up. Now, the first one was just before the Great Depression here. Now, I don't know if you know about the Great Depression, but it was the biggest recession in history, and it led to the complete loss of wealth for so many individuals. And the PE ratio was at around 30. And you can see what happened after it immediately crashed to a very, very low, just about 6. The next time that it got this high was During the dot-com bubble, where it was even higher, it's sitting at about 44. And what do you know? Crashed afterwards. It's now trading at about, the P ratio is about 35. And that means that we're paying a lot of money for a small amount of earnings. And it's never been this bad apart from during the dot-com bubble. Another indicator to look at is the fear and greed indicator. So this is just something that's done by Bloomberg, who are a journalist newspaper out in America. And it's an indicator of market sentiment. What are investors thinking about the market? And it's what's known as a contrarian indicator. So when it's towards extreme greed, it's not good. What it means is that people are too euphoric about the market. They're greedy. They're trying to buy things at overinflated prices. And that means that we should expect to move the other way. Okay, it's not like it doesn't always happen, but it's more often than not we're seeing a move the other way. And the higher that greed goes, or the lower the fear goes, the more likely it gets that it will move the other way. So during the dot-com bubble, this was sitting at 950, which is very high. It's quite high up towards extreme greed. It hadn't been that high for a long, long time, and it wasn't that high for the next 20 years. Until now, where during the pandemic, it reached an extreme greed rating of 1,250, and that has just never been that high. So that indicates to us that there's a lot of people in the market who are being very greedy, buying stocks at inflated prices and not worrying about the actual fundamentals of the company. This next one is just a little interesting aside. It's not on its own something that indicates a bubble, but it is an interesting parallel with the previous dot-com bubble. So during the dot-com bubble, people were really hyped about tech stocks, and the market value of the US economy, of the US market, was highly concentrated in tech stocks. 37% of the market value was all the tech stocks. Today, it's at 40%, so even higher. And that's indicative of people's belief that tech is what's driving our future, right? Tech companies are going to improve our lives, make huge profits in the process of doing so. But this overbalance of money in tech is a potential indication that the companies can't keep up with people's belief in them. And if that turns out to be true, you'll see a lot of money move out of those tech companies and the whole market collapse as a consequence. I'm really glad that Chris wanted to talk about IPOs this week because it saves me from explaining them. But if we just quickly recap, an IPO is when a company first becomes available for people like you or I to invest in. Okay. Now, between 2000 and 2020, there were about 175 IPOs per year. So every year, about 175 companies would go to the market and be publicly investable for the first time. During the dot-com bubble, that was about 500 per year. Now, why was that so high? Well, what it indicates is that companies are aware that investors and traders are paying too much for them. Okay, it means that they can go to the market and get a lot more money for their company than they would at other times. So seeing a large number of IPOs is quite indicative to us that companies are aware that the prices in the market are too high and they're taking advantage of it. They're taking advantage of the investors. Why do I bring this up? Well, last year, there were 450 IPOs in the US market, which was a drastic increase from the period since the dot-com bubble. And you can see is approaching those same levels that happened during the dot-com bubble. The next thing to look at is cash borrowed. Now, this is referring to the margin that I talked about in the short selling presentation. People are trading and investing with money that they don't have, that they're borrowing. Now, on its own, this doesn't mean much. People are investing with $722 billion of borrowed money. Well, what does that mean? Because during the dot-com bubble, it was only at 37 billion. So it seems like, well, we're already well past it. So surely if this was going to cause a crash, it would have happened already. It's important, however, to look at the ratio of cash borrowed to collateral. So how much people are borrowing for how much they put in. And if you look at that ratio, it's pretty much identical to how it was during the dot-com bubble. This is, again, an indicator of high speculation and euphoria. People are just borrowing money because they're certain that they're going to make money by selling a stock later at a higher price. If that changes, if they can't keep borrowing that money, well, then they'd have to sell their shares to repay their loans, and that would lead to crashes in the price. Well, the question then is, what would cause them to need to pay back those loans? Well, at the moment, we're dealing with basically free money. Okay, so this is a bit of a macroeconomic thing to look at, but the US government, the UK government, a lot of places in Europe have got historically low interest rates, and we're currently sitting at about 0%. That means it's essentially free to borrow money. Okay, I can borrow £1,000 from my bank, and I'm going to pay basically no interest on the loan. And that's been the case since about 2009. That allows people to borrow a lot of money to invest in stocks, which drives up the price. Now, during 2017 onwards, we started to see a slow increase in interest rates. And from that same period, we started to see a lot more volatility in stocks, more crashes, more corrections. And as they've in fact had to since, thanks to the pandemic, lower those interest rates again. What that means is the interest rate might be the one thing that pops this bubble. If they bring up interest rates, there's a lot of borrowed money in the market that's going to have to be paid back. And that means that shares are going to have to be sold. Prices are going to come down. That will cause more people to have to sell their positions, and we might see that crash. So you might be sitting here going, well, okay, well, this is an investment group, and I'm telling you that I think the market's overinflated. So what should we be doing? First of all, I can't tell you what to do with your money. You know, I'm not an investment advisor. I can only tell you what I'm personally doing. My method at the moment is to keep at least half of my money in cash, because cash protects me. It allows me to buy in, if there is a crash, to stocks at a lower price. The other half of my money, I'm holding stocks that I believe in for the long term. You know, during the last dot-com bubble, Amazon was trading at about $100 per share and lost 95% of its value. It came from $100 down to $5, and it's now sitting up at $3,500. So although there was a massive drawdown, if you are willing to hold for that length of time, you can still make good money, but you have to be willing to hold for it to recover. So I'm investing money that I'm willing to hold for the long term, and also taking shorter term positions to try and get a little bit of extra cash out of this upward move. If you guys have got nothing better to do, like me, and you're interested in learning more about this, I'm going to post a link in the chat of the article that I built this presentation on. It's quite well explained. It's nothing too mathsy, and I'd recommend just having a quick read through it. It'll take 10 minutes.